Hi, you might be sitting there right now thinking you're doing everything right. You opened a TFSA account, you're contributing every month, consistently so, and in your mind, you've already won tax free, long term, and safe. It sounds like the perfect investment. But what if I told you your TFSA might look right, but it's not actually working for you? Not because you're doing nothing, but because of how you're using it. Let me ask you something. Where is your TFSA invested right now? If it's mostly in South Africa, well, you're not alone. In fact, that's exactly what most people do because it feels right. You're investing in what you know, what feels comfortable, and what feels familiar. And that gives you a sense of control. But here's the uncomfortable truth: familiarity does not always mean better. Sometimes it means limited. Your TFSA actually allows you to invest globally because it's not governed by Regulation 28 of the Pension Fund Act in South Africa. This is a major opportunity because it means you're not restricted to South African markets or South African assets only. You can also access global markets and invest in those global markets. This then changes everything. Let me show you why this matters. Over the past 10 years, many balanced funds in South Africa have returned around 7 to 9% per year. Solid, stable, and predictable. But globally, the S&P 500 has delivered closer to 12% to 15% per year over long term. Now, at first, that difference doesn't feel huge, but over time, the gap becomes massive. And most people don't realize it because they're too focused on what feels safe. And just to be clear, this doesn't mean that South Africa is bad. South Africa is still good. It has good assets as well. There are strong options locally. Even ETFs like Cetrix MSCI World ETF allow you to access global markets from South Africa itself. The real point is, if you only stay local or invest local, you might be limiting your growth without even realizing it. So, why does this happen? You might be wondering. Why do so many people stay local even when they don't have to? It's simple. Because unfamiliar feels risky and familiar feels safe. But in investing, safe does not always mean growth, and comfort can quietly cost you money over time. Now, let's talk about something else you might be doing: dividends. When that money comes in, it feels good, right? It feels very good. Like your investment is finally paying you. So, what do most people do? They take it out and they spend the dividend. But here's what they don't realize: that decision is slowing everything down because real growth doesn't come from spending returns, it comes from reinvesting those returns. That's how compounding works. Your money starts earning money, and that money starts earning even more money. And over time, that's the difference between a TFSA that looks okay and the one that actually builds wealth. Now, here's the part most people struggle with: time. Because we all want results quickly. We want to see our money growing. We want proof that it's working. But investing doesn't reward impatience, it rewards consistently over time. At the beginning, growth feels slow, almost invisible, but that's where most people quit. But if you stay invested, something powerful happens. Growth starts to accelerate. And this is where those returns differences really matter. Because over time, the difference between 8% and 12% is not small. It can mean hundreds of thousands more in your TFSA. Sometimes even close to double. But only if you stay long enough to see it. So, if you want your TFSA to actually work for you, you need to shift how you think about it. Focus on growth, not just safety. Think beyond South Africa, not just what's familiar. Reinvest your earnings or your dividends. Don't interrupt compounding. And most importantly, stay invested long enough for time to do its job and compounding to do its job as well. Remember, your TFSA is one of the most powerful tools you have, but only if you use it intentionally. Otherwise, it just becomes another savings account, and you don't want it to be like that. Remember, this content is for educational purposes only, not a financial advice. Always consult a qualified financial advisor before making any decisions. I am Lekgabo, the monistical nerd, making money and sense, not mysterious. Thank you. Follow, like, and subscribe for more.